All right, class, welcome back. In our previous sessions, we've really laid the groundwork for the core principles of accounting. But today, we move beyond the textbook. We're going to tackle a high-stakes scenario that I guarantee you will face in your careers. We're not just going to look at the what of the numbers, but the how and the why, the actual anatomy of a confident, well-founded business decision. Okay, let's just dive right in. I want you to step out of the classroom for a minute and put yourself in the corner office. You're the CEO of a successful, growing company, and sitting on your desk is a single proposal, a single question that could define the next decade for your company. Should we build the new factory? And let's be clear, this isn't just some case study problem. This is a multi-million-dollar decision. It has real consequences for your employees, your shareholders, your entire position in the market. The pressure is on.
So your first instinct, naturally, is to look at the numbers. You'll see things like the projected ROI, the return on investment, how much profit you'll make for every dollar you put in. You'll look at the payback period, which tells you how long it'll take to earn back your initial investment. And the answer seems like it's right there in the spreadsheets. But hold on. Before you even think about analyzing those figures, you have to ask a much more fundamental and, frankly, a far more important question. Where did these numbers come from? Can you actually trust the data that you're basing this monumental choice on?
And that critical question leads us directly to the bedrock concept that separates a smart, strategic decision from a catastrophic gamble. And that concept is the internal control system. Now, I know a lot of students hear internal control, and they think, oh, that's a dry topic for the auditors. But I'm telling you, it is one of the most vital strategic tools a leader has. It is the absolute foundation of trust within an organization. Now, this formal definition, it covers a lot of ground, right? Safeguarding assets, promoting efficiency, all very important. But for our purpose today as decision makers, I want you to laser focus on that final clause to ensure accurate, reliable accounting records. Because really, every other part of internal control serves that ultimate goal. Because without trustworthy information, you simply cannot make sound decisions, period. To make this concept a little less abstract, let's use an analogy. Think of it this way. If the C-suite, the management team, is the brain of the company, then the internal control system is its central nervous system. This system is what sends reliable signals from all parts of the organization, from the sales team, from the factory floor, from the finance department. All of it flows to the brain. This allows the brain to see what's really going on and make intelligent, coordinated decisions. If that system is weak, well, the brain is flying blind. So how does this nervous system actually work in practice for our big factory decision? Well, for internal controls to be effective, information has to flow freely and accurately between all the departments. This isn't just a nice idea, it is an absolute prerequisite for success. A decision of this size can never, ever be made in a silo. Just look at this pathway. The sales department can't just throw a big, exciting growth number over the wall. No way. That forecast has to flow directly to the operations team. They're the ones who have to figure out if they can actually meet that demand and, crucially, at what cost. And then that information flows to finance, who has to independently validate those costs and model the real financial impact. As the leader, your job is to make this happen. So let's act this out. You'd be in a meeting saying, okay, team, sales is forecasting a 30% jump in demand. That's fantastic. Operations, what does that mean for our supply chain? What are the real costs to scale up? And finance, I don't just want a summary. I want to see the documentation supporting these new cost estimates. Let's walk through it together. And this slide right here shows you why that conversation is so incredibly vital. Without these connections, you might approve a factory based on a fantastic sales forecast, only to discover months later that a critical raw material is impossible to get, or that construction costs were wildly underestimated. This free flow of information lets you see the whole picture. It helps you spot risks early on and make sure everyone is working from the same set of verified financial records. Without it, your million-dollar decision is built on a foundation of sand. Okay, now for what I think is a crucial point. Remember in our little role play, the manager demanded, I want to see the documentation. This isn't about creating pointless paperwork or bureaucracy. In the world of accounting and finance, documentation is the physical manifestation of truth. It's about creating an unbreakable, auditable trail of proof. Every single significant number in a final report has to be supported by a trail of evidence. So, for our factory, that projected cost of steel, that isn't just a number someone typed into a spreadsheet. It's backed up by actual purchase orders from suppliers. The labor cost estimates, they're supported by union contracts and payroll records. The company's ability to even pay for this project, well, that's evidenced by its financial records, which, by the way, have been checked by independent audit reports. This is the bedrock of legitimacy. I want every single one of you to burn this phrase into your professional memory. This is a fundamental truth that you will carry with you for your entire career. It ensures transparency, it creates accountability, and it provides legitimacy for every transaction. A conversation in the hallway about a supplier discount, that's just talk. But a signed purchase order with that discount on it, that's proof. It's the difference between an assumption and a verifiable fact. So let's bring all this back to the CEO's office. We've established a system where information flows freely, and we have a culture that demands rigorous documentation. How does the decision-making process fundamentally change when you have this kind of structure in place? Okay, look at this slide carefully. This is the fork in the road. And frankly, the right-hand column is where so many students, and even seasoned professionals, make a critical mistake. They get drawn to that summary number from a single source, and they start their analysis there, without ever asking about the process that created it. The right way, on the left, it's not faster, but it is robust. The process is transparent. Anyone can lift the hood and see exactly how the numbers were generated. This gets rid of the black box and replaces a wild gamble with a calculated, defensible strategy. This is how leadership can move forward with genuine confidence. So what's the big takeaway here? It's this. A great decision is not defined by its outcome. Outcomes can always be affected by luck, good or bad. A truly great decision is defined by the quality and the integrity of the process that led to it. A strong internal control system gives leadership confidence not just in the final numbers they're looking at, but in the entire organizational system that produced them. And that is the true source of a confident choice. So as we wrap up, I want you to realize this isn't just about accounting rules. This is really a question of leadership. Your job as a future manager, a director, or a CEO isn't just to make decisions. It's to build an organization that is capable of making great decisions. And that always begins with building a culture of trust, transparency, and accountability in the data that fuels your entire enterprise. So the challenge I'm leaving you with is this. How will you make sure your team values proof over opinion and a solid process over a tempting shortcut? Think about that.